Welcome to this video today, which is all about crowd psychology and how to profit from it in the Forex markets. Now, in terms of what we're going to be looking at today, we're just going to be looking at the basics of how a crowd moves markets and basically how you can trade contrary to the majority of losers at the right time with high probability trade setups. And basically, you just outline a very simple strategy that anyone can make money with. Now, before I discuss the strategy, first of all, kicked off the video with a short clip there of a flock of starlings and the Liverpool cop singing "You'll Never Walk Alone." What have they got in common? They're emergent systems. Now, emergent systems exist throughout nature in terms of different types of animals. They also exist in terms of humans. Now, the key point to remember about an emergent system is when it groups together, there is no leadership to the group. The crowd feeds off itself. Now, that will become more clear why that's so important as we go through the video. Now, if you've ever been in a crowd, you'll understand the pull of the crowd. I've been, amongst 10,000 Liverpool fans singing "You'll Never Walk Alone." I don't even support the club. And yet you sing it, you get empowered, you feel with the crowd, you feel good. And that is just a natural human reaction. Man is a sociable being. We've been used to banding together in herds in Stone Age times. That's not always made us feel safer. We always feel safe in a crowd. And in terms of the markets, the majority always feel safe with the crowd. However, of course, we know the statistics that the majority of traders lose. So we don't want to be with the crowd. We actually need to walk alone. And, I think a lot of traders, they don't do their homework about crowds before they come in the market. So I would strongly recommend you read the book, The Crowd by Gustave Le Bon. And I did a quote from him as we came in. It's very true. When people get into a crowd, intellect counts for nothing. Give you an example. Albert Einstein, one of the greatest minds of all time, lost money in the South Sea bubble. And he made the comment afterwards that I can calculate the movement of heavenly bodies, but not the madness of crowds. Now, crowds, they have not changed over the years. They will always push prices too far to the upside or too far to the downside. And when you've got that group mentality, the herd, and a trend is strongly in motion, they want to believe it isn't going to end. And if you notice, the news always reinforces what is going on in the markets. And you'll often find that commentators will say this market will go on forever, then it immediately reverses. Now, the reason that happens, of course, is when everyone thinks alike, everyone is likely to be wrong. That's a quote from Humphrey Neal, who actually developed the art of contrary thinking. He was the first person to do it. I strongly recommend you read that book as well. Once prices have gone too far, it doesn't take much for them to break lower once the buying or selling is exhausted. However, you've got to spot the turning points, and a crowd might be stupid, but it can be very powerful. So you've got to be very careful in the way that you time your entry into the markets. Now, in terms of over history, you will always see price spikes to the upside or downside that run too far. Those big short-term price spikes never last. They always fade, and you want to come in and trade them. So how do you do it? Well, you can do it technically, and I would strongly recommend, if you want to do it technically, I'm just going to outline the way I do it. And I always basically look, first of all for a price spike on a chart, and then I look for the standard deviation from the mean, i.e. how much has it moved away from the average price. Now, a lot of price action traders scoff at the idea you should use any indicators at all. I would say the most important indicator that I use would be a Bollinger Band. It just gives me that insight to how far prices are away from the mean price. I know they're probably going to come back if they've moved too far away. So, I want prices at the outer Bollinger Band, or even better, right outside of it. Then I know that I'm going to get a high probability trade. Prices are probably going to fall back to the average. You can test it yourself with a Bollinger Band or any standard deviation tool. The concept of moving too far too quickly, then coming back to the mean, is a proven concept. It's very simple to learn as well. Once I've got my price spike and I see it, it's gone too far, I like to use momentum, diverging from price, to sell the market. Now you can use price action for this if you want, a reversal candle. I like to use momentum though. I like to come through a level just to give that confirmation. I also like to keep my stop a good way back from the high, and I've never really succeeded when I put my stop too close. You see a lot of traders who put their stop like 10 pips behind the high. I would always use 50 to 100 pips, and I found that's kept me out of trouble when I've done it. Now, in terms of using technical setups, I'm just giving you a very simple one that you can use, but I always think you should also look behind the charts. And by that, get more confirmation of what the sentiment of the market is. So how do you check the sentiment? Well, if I see a big price spike, I normally go to one of the big Forex sites, like say Forex Factory, where they do a poll. I want to see how many of the traders on that site are, let's say, bullish if there's a big uptrend. And if the percentage is up at 70, or even better above 90, that reinforces my view. Also like to look through the news, see how many commentators are saying, this move will never end, and etc. We know they always end. We know that, the majority are caught wrong at those big turning points, and so are most of the analysts and so on who write on newswires. Another tool to use, mentioned in other videos, Net Traders Positions at the CFTC, a free tool, and it will give you basically the breakdown between speculators who are greedy and wanting to make money, and commercial interests who are hedging. It's a well-known fact that commercials are always on the right side of turning points. So if you see the speculators heavily long, commercials heavily short, you're probably going to get a turning point to the downside. Now, in terms of price spikes, you do have to be careful when you trade them, that you don't jump in too soon. And I'm all for using the fundamentals to back up the technicals. Another fundamental tool to use is like if you've got a very bullish move and the market is expecting bullish news, that bullish news comes out and the market fails to move higher, then it's probably going to break to the downside. It means the buying is exhausted, and vice versa in a bear market. I think in terms of trading contrary to the crowd, it's a simple concept to understand, and you can learn simple tools. I've just given you the ones that I use, and you can practice them, and you can become proficient at swing trading against the crowd at important market turning points. Now, markets will never change. Crowds will always act the same way. This is shown in the statistics of winners to losers. The ratios never changed. It doesn't matter how much technology we see, that ratio will never change. So, if you've got a simple system based upon proven tools that can give you those high property setups, you can trade against the crowd for profit. Now, in terms of, I mentioned Gustav Le Bon's The Crowd earlier on, that book is now free on the net. You should go and get it. It is one of the greatest works on crowd psychology you can read. I'd also recommend you read the book Extraordinary Popular Delusions and Madness of Crowds by Charles Mackay, written around the same time in the 1800s. A wonderful book. And Charles Mackay said, men think and go mad in herds and only return to their senses one by one. How true is that of the markets today? It's very true. It's always been true of markets, in fact. So recommend you get those free books. And also, I've mentioned Humphrey Neal, The Art of Contrary Thinking, another worthwhile book getting. In terms of the technical tools you need, you can research them on the net and basically practice them. And also learn to go against the crowd, especially with the news. When it looks like a market is never going to turn around, it always does. If that is backed up by an extreme technically on the chart, you've got a high probability setup. Now what I'm going to do is just quickly finish up with a short clip of the Liverpool cop crowd again back in the 60s. And I saw this documentary where they tried to explain how football crowds behaved. And it's, they're trying to work out the psychology of the crowd. It's only a short clip, wonderful clip. And then a final quote from Gustave Le Bon: keep it in mind when you trade the Forex markets. That is the video for today. I hope you enjoyed it. Take care. Have a good day.
An anthropologist studying this cop crowd would be introduced into as rich and mystifying a popular culture as in any South Sea island. Their rhythmic swaying is an elaborate and organized ritual. The 28,000 people on the cop itself begin singing together. They seem to know intuitively when to begin. Throughout the match, they invent new words, usually within the framework of old Liverpool songs, to express adulatory, cruel, or bawdy comments about the players or the police. But even then, they begin singing these new words with one immediate, huge voice. They seem, mysteriously, to be in touch with one another, with Wacker, the spirit of Scouse. The spirit is good-humoured and generous when they're winning, but not necessarily when they're losing.